let's start with these Fed officials chiming in, because this was interesting, Danielle. This made headlines. You got Beth Hammack saying rates could be on hold for quite some time. And then you had Lori Logan echoing that, saying current policy stance appropriate, she says. I mean, what did you make of that, Danielle? That does not sound like two Fed officials who are, jumping here, itching to cut rates because of this labor market.
It certainly does not. And I would venture to say that they have not been following some of the headlines that we've received in the last few days, whether it be from ADP, Indeed, LinkUp, Challenger Gray and Christmas, the highest January layoffs that we'd seen since 2009, the lowest hiring that we'd seen since 2009 for a January. So it does concern me. Lori Logan was quick to point out today that politics are not entering into Federal Reserve officials' analysis of the data. But given other measures, other real-time measures of inflation, such as Truflation, TRU, which really has become more adopted by the street since its addition to the Bloomberg terminal recently. Their headline is 0.74 as of this morning, and even the core, which strips out food and energy, was at 1.15%, really reflecting disinflation in services and the declines that we continue to see in rents.
So this labor market, Danielle, listen, we got the big report tomorrow, but the data points we began leading into that. I mean, you saw that Challenger, ADP, JOLTS, it's all pointing to a cool labor market. Why is it cool, Danielle? Explain that.
Well, I think the other data that was maybe not as appreciated was the employment cost index, which is actually Federal Reserve Chair Powell's favorite gauge of wage inflation or lack thereof. And that printed cooler than expected this morning at the lowest rate since 2021. And I bring up the issue of wages to answer your question in saying demand for labor is simply not what it needs to be. So this is not a supply issue. We wouldn't be seeing wage disinflation if it wasn't the case that demand for labor was cooling in the cyclical private sector of the U.S. economy. And that is something that I think that both Hammack and Logan did not pay heed to in their remarks today, which does lead one to believe that politics has entered into the analysis.
Danielle, could it be also, I'm just wondering, because the other side of the coin here, some are concerned still, Danielle, inflation, listen, it's a lot lower than it was, but you're still not at the Fed's target, right? You're still at 2%. And some being concerned, like, listen, you're cutting even when Atlanta Fed GDP, the tracker, it's got a 4 handle on it, Danielle, and they're worried you cut into that, maybe you reignite inflation.
Well, it's interesting you raise that point. The gentleman, Ben Herzon, who invented the GDP tracking model, just before I came on the air with you, came out with his own revisions to fourth quarter GDP, which is he's now pegging it somewhere around 2.5%, and the first quarter at somewhere around 2.3%. So it really does depend on how a GDP model is crafted. And we also get annual benchmark revisions tomorrow to payrolls. If they're as deep as we expect for them to be, then we're going to see income backed out of GDP figures. And indeed, that is one of the reasons it takes so long in the United States to date a recession, is because it takes a very long time for the Bureau of Economic Analysis to back that income data out of prior GDP prints. So I would be very cautious in looking at the great big numbers coming out of the Atlanta Fed GDP and understand that a model is only as good as its architect.
How many cuts, Danielle, for the Fed in 2026? What would be your base case right now?
I think, well, our base case right now is four interest rate cuts. And if we don't see any at the March or April FOMC meetings, then it would be incumbent upon the individual, presumably Kevin Warsh, who's going to succeed Jay Powell, to come in with larger rate cuts than what are expected to play catch up for the Fed failing to ease in the face of such obvious weakening in the labor market.
How about Warsh? I'm curious to get your take on that, Danielle. Trump has said, listen, that's his guy to lead the Fed. Did you agree with that?
Well, I have a tremendous amount of respect for Kevin Warsh. He was at the Fed when I was at the Fed, and I happen to agree with him that the Federal Reserve needs a much smaller footprint in the U.S. Treasury market, which would advocate for quantitative tightening. Just those two letters, QT, send shudders down the spines of market participants. My only concern is that Jay Powell was just as resolute as Warsh when he first started in 2008 and 18, and he was forced to back down in the face of great market turbulence in late 2018. So it remains to be seen whether or not we can truly get a next generation of younger thinking, kind of maverick type of central bankers, if indeed the markets test that person.
I had some guests, Danielle, some investors, and they've been in the game for a long time. They would have preferred BlackRock's Rick Rieder. They told me, listen, there's a guy who really knows the markets. What did you think of that?
Well, of course, the market would have preferred Rick Rieder above anybody else, and certainly he would have a greater understanding of the financial markets. But that's not to take too much away from Kevin Warsh, who started at Morgan Stanley and himself has a very intimate understanding of the financial markets. In fact, he was instrumental in guiding Ben Bernanke in the aftermath of the great financial crisis because of the depth of knowledge that he has for the financial markets. So I certainly wouldn't take that away from Kevin Warsh.
One other data point I want to run by you, because we got retail sales today too, Danielle. You saw this. It did come in softer than estimated. I'm just curious what you made of that. And then just generally, Danielle, what do you make of the consumer here? How healthy, how resilient?
Well, again, I'll tie back to the fact that wages are not growing as quickly as they once were. So how are you going to squeeze blood out of a rock? How are you going to squeeze consumption in the merry month of December for it to have actually, to the second decimal point, printed negative for the month? That was quite a surprise, including the negative revisions to November. It's clearly also based on some delinquency data that the New York Fed published subsequent to that retail sales report that the U.S. consumer is hurting outside of that top 10%.
Danielle, thanks for your time today. Appreciate it.
Two new voting members of the Federal Reserve say they prefer to hold rates steady now on concerns about inflation. Cleveland Fed President Beth Hammack said earlier today she believes that monetary policy is, quote, in a good place to maintain rates at current levels, and that based on her forecast, the central bank could be on hold for, quote, some time. Hammack says inflation is still too high and sees the risk that inflation could remain persistent around 3% this year, as it has been the past 2 years. She says she needs to see decisive evidence that prices are coming down, and rather than trying to, quote, fine-tune interest rates, Hammack says she'd prefer to, quote, err on the side of patience as the Fed assesses the 3 rate cuts that they did last year and the impact on the economy. Now, elsewhere, we also heard from Dallas Fed President Lori Logan, who says she's also concerned that inflation remains too high and that the 3 rate cuts that the Fed did last year to try to shore up the job market are actually pushing up inflation risks now. In a speech in Austin, Texas earlier today, Logan saying, quote, after last year's rate cuts, it is uncertain how restrictive policy currently is. We'll learn in the coming months whether inflation is coming down to our target and whether the job market will remain stable. If so, this would tell me that our current policy stance is appropriate and no further rate cuts are needed to achieve our dual mandate goals. Now, while Logan does anticipate that inflation will drop later this year as tariffs work their way through goods prices, she says that, quote, she's not yet fully confident that inflation is on its way down to 2%. So just some evidence there from 2 members of the Fed that they need to decisively see a drop in inflation before they consider any rate cuts.